In 2019, WeWork was valued at $47 billion, one of the most valuable startups in the world.
How fast are you growing?
Very.
What kind of numbers are we talking about?
We're talking about probably one of the fastest physical expansions that has been seen for the past 10 years.
It had raised nearly $12 billion in venture capital. It operated in more than 100 cities. Its founder appeared on the covers of business magazines. It then filed for an IPO.
The young CEOs of today are afraid of going public.
And the public markets read the prospectus, and within weeks, the valuation collapsed from $47 billion to less than $10 billion. The IPO was abandoned.
WeWork is withdrawing its IPO prospectus. Now, this, of course, comes after the two new co-CEOs got together, talked about it, and I'm sure realized that they didn't have much of an option.
The founder was removed. A multi-billion-dollar bailout followed. The question this episode is asking is not what went wrong with WeWork. It is asking something more structural. How did a financially fragile business sustain such a valuation for nearly a decade?
WeWork has reported a first quarter net loss of $2.06 billion.
If I had to pick one word to describe WeWork's 2019, it would be cluster.
The company was one of the hottest startups in history. Then it plunged from nearly $50 billion in value to basically worthless in just 6 weeks.
That is WeWork.
Because the structural weaknesses inside WeWork's business model had existed from the very beginning. Understanding those weaknesses reveals something larger, not just about WeWork, but about how private markets themselves operate. WeWork was founded in New York City in 2010. Its business model was straightforward: sign long-term leases on commercial office space, subdivide that space, add design and amenities, and rent it to individuals and small companies on flexible, short-term terms. At its most basic, it was a real estate sublet business. But WeWork did not position itself as a real estate company. It positioned itself as a technology platform, a physical social network, a new model for how human beings experience work. Founder Adam Neumann described WeWork's mission as elevating the world's consciousness. He called WeWork's members a community rather than tenants. And in the context of the 2010s startup era, in the wake of other startups like Airbnb, Uber, and Slack, the framing was taken seriously. By 2019, WeWork operated in more than 100 cities. Its valuation had reached $47 billion, and SoftBank's Vision Fund had committed nearly $10 billion to the company. After a 12-minute meeting between Neumann and Masayoshi Son, the narrative had become extraordinarily powerful. The narrative, which had never been tested by public market scrutiny. We break down corporate collapses and structural failures like this into clear, understandable systems. Subscribe if you find this analysis useful. To understand why WeWork's valuation collapsed so dramatically, we need to examine the structural design of the business itself. At its core, the model contained a fundamental time mismatch. WeWork signed leases lasting 10, 15, sometimes 20 years, fixed obligations that continued regardless of economic conditions. Then it rented that same space to members on monthly rolling contracts, agreements that could be canceled with 30 days' notice. In other words, WeWork had locked itself in long-term liabilities while relying on short-term cancelable revenue. But the moment growth slowed, or an economic downturn arrived, the structure became unstable. Members could leave quickly. Lease obligations could not. By early 2019, WeWork had committed to roughly $47 billion in future lease obligations, while generating less than $2 billion in annual revenue. The gap between what the company had promised to pay and what it was currently generating was growing every quarter. The company had effectively built a global real estate portfolio, financed by revenue that could disappear in a single quarter. The second structural weakness was the business model itself. In 2018 alone, WeWork lost approximately $1.9 billion. The company was spending more money than it was taking in, at scale, in mature markets, and years into its existence. That loss was not the byproduct of experimental technology development, the way losses often are in early-stage software companies. It was the direct cost of operating and expanding a global real estate network. And unlike software companies, real estate does not scale with negligible marginal cost. WeWork's product was physical space, where every new customer required another desk, another lease, more utilities, more staff. It did not scale like software. Its costs grew with its revenue, and by 2018, its costs were growing faster than its revenue. Let's try to understand this in a bit more detail. With the help of an example, take a software company. In year one, it builds a product and acquires its first 1,000 users. Owing to high infrastructure costs, it is in losses. It gradually scales its business and adds new users. By year 5, it serves 10 million users on largely the same infrastructure. At this point, the increase in cost of adding the 10 millionth user is insignificant compared to the revenue generated from this user. This is what we call operating leverage, where fixed costs are high relative to variable costs, meaning that a small increase in sales can lead to a disproportionately large increase in operating profits. Revenue climbs, but costs increase at a much lower pace, and hence, margins expand. Now take a company with same revenue model as WeWork. In year 1, it signs leases in New York and San Francisco. In year 5, it signs leases in 100 cities. Every new city requires a new lease commitment, 15, sometimes 20 years long. Every new location requires fit-out costs, utility contracts, cleaning staff, community managers. Basically, costs increase with increase in revenue. The gap between revenue and costs never increases. And even if it does, it is way too lower than the gap created by the software companies. Look at the two lines on the right side of this chart. The revenue line and its cost line do not diverge. They move together, almost in parallel, because the product is physical. It cannot be duplicated, it can only be replicated at full cost in every new market. Moreover, WeWork was not even at a stage where it could generate profits. By 2018, WeWork was generating $1.8 billion in revenue and spending $3.7 billion to do it. Yet despite this structural limitation, each successive funding round valued the company as if it were a technology platform. By 2018, the pressure created by this structure was becoming visible. WeWork's expansion strategy required opening new locations faster than existing ones could mature. With every new city entered and every new lease signed, the gap between its obligations and revenues widened further. Short sellers had begun accumulating positions against WeWork's debt. Several published analyses started questioning the sustainability of the model. These warnings did not penetrate the private market system. SoftBank continued to deploy capital. WeWork continued to expand. The narrative held, but inside the company, the cash position was becoming critical. WeWork needed the IPO proceeds not just for growth, but to sustain its ongoing operations.
When your business has a mission, and that mission is world-changing, and people can buy into the mission, then they're going to come in. Then they need a culture that they're going to enjoy. To create that culture, you got to put employees first.
Entire expansion strategy had been structured around the assumption that the public markets would provide validation and capital. That assumption was about to be tested. The accountability gap in private markets does not last indefinitely. It closes at the moment of exit, when a company goes public, is acquired, or fails. At that moment, the private valuation is tested against the judgment of a much larger, more diverse, and more skeptical set of market participants. For WeWork, that moment arrived when the company filed its S-1 prospectus with the U.S. Securities and Exchange Commission. For nearly a decade, WeWork had described itself as a technology company disrupting the global real estate market. However, on August 14, 2019, for the first time, it published its actual financial statements, and the numbers showed the company losing nearly $2 for every dollar it earned. It also carried $47 billion in long-term lease commitments, with no credible path to profitability. The $47 billion valuation collapsed almost immediately, not because the business had suddenly changed, but because accountability, which was deferred for years, had finally arrived. At the time of its bond filing in 2018, WeWork had already introduced a financial metric called Community-Adjusted EBITDA. Standard EBITDA, earnings before interest, taxes, depreciation, and amortization, already excludes certain costs like interest and depreciation. WeWork's version went further. It also excluded marketing costs, administrative expenses, and the cost of building new locations. In 2017, WeWork's standard adjusted EBITDA, the conventional measure, showed a loss of $193 million. To produce the community-adjusted figure, the company excluded an additional $426 million of operating costs. The result? A reported profit of $233 million. In other words, a metric that excluded most of the company's actual costs produced the appearance of profitability. When the S-1 was filed a year later, the 2018 numbers became public and the pattern had worsened. Standard adjusted EBITDA had deteriorated further to a loss of $666 million. But the reported community-adjusted figure moved in the opposite direction, rising to $467 million, because the exclusions had grown to $1.1 billion. In 1 year, the gap between what the business actually cost to run and what WeWork chose to report had more than doubled. The metric was not just obscuring losses, it was actively widening the distance between the reported number and the operating reality. That is the mechanism. The worse the underlying performance, the larger the exclusions needed to sustain the appearance of progress. Analysts had seen invented metrics before. When they reconstructed WeWork's real cost structure using the S-1 disclosure, the picture changed entirely. The narrative of a rapidly scaling technology platform began to look instead like a highly leveraged real estate operator with fragile unit economics. Investor demand for the IPO collapsed. The expected valuation fell from $47 billion to roughly $10 billion. The offering was withdrawn. Adam Neumann stepped down as CEO, and SoftBank, the company's largest investor, was forced to assemble a multi-billion-dollar rescue package to prevent immediate insolvency. Despite that intervention, WeWork filed for Chapter 11, bankruptcy protection, on November 6, 2023. The collapse appeared sudden, but structurally, it had been building for years. The S-1 did not create the problem. It simply made the problem visible. WeWork is a specific case, but the mechanism it reveals is not unique. Anytime a company raises capital from investors who benefit from rising valuations, the same structural condition exists. The accountability gap is not a failure of individual judgment. It is a feature of how private markets are designed. Understanding it requires only one question: when was this valuation last tested, and by whom? Over the past decade, companies have remained private for longer than ever before. Businesses that once went public after 5 or 6 years now frequently stay private for 10 or 15 years. During that time, valuations are determined by a relatively small group of participants. Financial disclosure is limited, and the mechanisms that normally force a reconciliation between narrative and financial reality are delayed. This does not mean those valuations are always wrong, but it does mean they can remain untested for much longer than valuations in public markets. And when that test finally arrives, the adjustments can be brutal, because a valuation that has never been tested by the market is not a measurement of value. It is simply the price the last investor was willing to pay. But this mechanism is not unique to WeWork. It has appeared across markets, sometimes in financial structures, and sometimes in the product itself. And in each case, the outcome is the same. Reality eventually replaces the narrative.